Happy Monday, everybody. All right. Last week, I watched a great interview with a macroeconomist named Lynn Alden. Lynn is someone that Greg and I have followed for years, and she's just super sharp. She looks at global trends. She puts out a lot of good information. So this interview was talking about the pros and cons and the consequences of having a world reserve currency. So I took some notes. I thought you all would appreciate it, especially when it comes to what to invest in. So, first of all, what is a reserve currency? It's the currency that the whole world needs for international trade. Now, you know, if you've watched us long enough, that one of the most important products for international trade is oil. Oil keeps the global economy moving. And with Henry Kissinger's petrodollar deal, that's been a major factor in global politics. But it's not just oil, it's everything. Everything has to be bought and sold internationally, whether it's with the US and other countries or between other countries. And so that's where the dollar comes into play as the current global reserve currency. Now, the pro is the other countries need your currency. Here's the con is that the host country is then there's pressure to keep that trade going until you create a trade deficit, where you're buying more stuff from these countries that need your money just to keep them needing your money, right? And that's the issue that we've gotten ourselves into now, is that the deficit has grown and grown. And with that, we have exported jobs to these other countries so that they can make the stuff and sell it to us. And so we use our reserve currency to buy it from them cheaper than we could have made it in the first place. Cheaper is good for the consumer, but it's bad for the worker, right? Because the workers then lose those jobs to these other countries. Now, these tariffs that Trump has been talking about, his goal is to bring jobs back, reduce that deficit, that trade deficit, and bring jobs back to the US, raising the middle class wages. All right. Because the wages, I'm sorry, because those jobs have been pushed out overseas for so long, it's not like you can announce a tariff like that, but you can't just bring jobs back like that. And that's what we're starting to see now is when will the jobs come? And I don't know if it's true or not, but Alden was saying that she expects it to take 5 to 10 years before jobs really start coming back because you've got to train your workforce to do those jobs also. And when it comes to the U.S., the first jobs we would be bringing are not necessarily the jobs making extension cords or stuff like that, but like drone technology, computing, chip manufacturing, the stuff we used to be number one at, which have now moved overseas. All right, so 5 to 10 years. Now, as you know, President Trump has a 4 year term now. So this would take a long term concerted effort and political will over the long term to keep this ball rolling. Probably won't happen just in one term in terms of bringing meaningful jobs and manufacturing back to the US. All right. Now let's look at China versus the US. Who has the stronger hand to play? Well, when it comes to tariffs, the US has the trade deficit. China relies on us to keep that deficit going and buy their stuff. So tariffs on China will hurt them even if they reciprocate with tariffs. Tariffs on both countries will hurt China more than it'll hurt us. So we have the advantage. If it comes to a war of attrition just with tariffs, the United States wins that one. But it's not just tariffs. This is a chessboard with multiple pieces. China may not have the strength of the tariffs, but they have the strength of our debt. Because as you know, we've gotten into greater and greater debt. Well, China has been gladly buying that debt. So now they're a debt owner of the US. Well, if they were to just dump their treasuries that they own, they could really spike rates up. And that's what Trump doesn't want. And we actually saw that happening last week. China was starting to flex a little bit. They dumped 10-year treasuries, and the price of 10-year treasuries, the yield started going up, which makes debt more expensive that we have to then pay. Trump doesn't want that. China knows that. So it's going to be interesting to see how this trade war goes because we're not equally matched, but both sides have strong tools to use in this. All right. Well, that gets back to the U.S. long-term debt cycle. And Lynn talked about this, but she was actually referring to Ray Dalio. And you all know I've talked about Ray Dalio before. He's a hedge fund manager, Bridgewater and Associates. His former CFO ran for governor for New Mexico, Domenici. She was his former CFO. Anyway, Dalio has talked about his concerns with U.S. debt and our trade deficit, and he's talked about the long-term debt cycle, which is a problem, and we're going to have to deal with it, and we're dealing with it now. So, and I kind of mapped this out so I can clearly articulate it. But the debt cycle is, you got the private industry who goes into greater and greater debt. Then you have a crisis of some kind. Think about the great financial crisis in 2008. The crisis came and the government had to bail out, right? So the government starts acquiring that debt. So they absorb it by paying out money and going into greater and greater debt to pay off the crisis, take care of the crisis. Well, what happens with the US debt? It grows and grows. Now, there's three options that the government has. And Dalio has talked about this. Over thousands of years, empires have continued to do the same processes. So the three steps that a country can make to take care of that debt is they can tax. That's never popular, especially if a politician wants to get reelected. So increase tax. They can default. That's never popular, because then your currency becomes worthless and people lose faith in your country. Or three, you can inflate your debt away. That's what has been the choice for the US government up till now. And it looks like that's continuing to be the policy, is to try to inflate part of it away rather than raise taxes. Okay, so now that gets to investments. What do you do in that kind of environment? And Alden talks about this. Ray Dalio talks about this. But you move into hard assets that aren't reliant on the currency, like the stock market. Stock markets are reliant on the currency, people buying and selling. But during a financial crisis or high inflationary times, and Dalio has talked about this in his book, and I've talked about his book, The Changing World Order. Money starts moving into hard assets, which is how we're investing. And so you start seeing money moving into gold. And we've seen that over the last couple of years, actually. Now, I did have a client ask, we saw a dip in the price of gold. And was that a once in a lifetime opportunity that if you didn't take advantage of it, you missed? No, not at all. This is a multi-year trend that has been happening and will continue to happen. And actually, there was another interview by Jan van Eck. Now, you may, if you're an investor of ours, you may have noticed one or two of your investments that were created by Van Eck, because Van Eck likes hard assets too. But Jan van Eck was talking about how this is a multi-year trend. That is not just that was the time to buy. There are good and bad times to buy in any one-day trade, but in the long term, what you want is to make sure you're on the right bus going to the right destination, and that's where we're at. So with that, I gave you a lot to process. You all have a great week. We'll see you next week. Bye-bye.